Good evening, everyone. We're going to be starting in a couple of minutes, so can we please ask you to take a seat? ضيوفنا الكرام، يسعدنا ويشرفنا أن نرحب بكم اليوم في الملتقى السنوي لتوقعات الاستثمارات العالمية لعام 2019 والذي قام بإعداده الفريق الاستثماري في بنك الإمارات دبي الوطني. اسمحوا لي بداية أن أدعو السيد ريتشارد دين مقدم الراديو في برنامج بزنس بريكفاست على راديو دبي لإلقاء الكلمة الافتتاحية. Good evening, ladies and gentlemen. It's our pleasure to welcome you to Emirates NBD's 2019 Global Investment Outlook, hosted by our Chief Investment Officer and his team. We're honored to introduce the MC for this evening, Mr. Richard Dean, the presenter of Business Breakfast Radio Show on Dubai Eye, to open the event. Thank you.
Tala Shukran Jazilan, very good evening. Thank you very much indeed for being here tonight. Listen, we've got a bunch of experts who've done some very serious statistical analysis on what's happening in the markets. Very quickly though, they've asked me to outline my perspective on what people are thinking at the moment. And the only perspective I can offer is that from the presenter's chair of the Business Breakfast radio show. And what's keeping people awake at night? Because we've got couple of 100,000 or so listeners, very similar to the people who are clients of Emirates NBD. And I'd say there's three things at the moment that are keeping them awake at night. And the first one is the earning money bit. The messages we get is, I'm concerned about my job, I've not had a pay rise for 3 years, I haven't had a bonus for 2 years, and I'm concerned that I might lose my job. Many of my clients are. That's one of the things that they tell us. Another of the things that they tell us that they're concerned about when it comes to investing is fees. They're very concerned about the levels of fees that they're paying when they're investing their money. They've read books like Money from Tony Robbins, the guru who's been here at the World Government Summit, who says you should just invest in low-cost tracker funds. They've seen the advice from Warren Buffett, who says you should just be investing your money in an S&P 500 tracker fund, reduce the fees. So that's one of the things, the second thing keeping them awake at night is fees when it comes to investing. And the third thing I'd say that's keeping them awake at night is the Dubai real estate market. Now, on the one hand, they're happy because their rents are coming down. But they're concerned that real estate prices are perhaps softening, and those with long memories who've been here 10 years ago know what happens when the Dubai real estate market takes a tumble. So they're a little bit concerned about these things, and I know these are issues that various speakers are going to address this evening. What I would say is, as well as hearing from these experts on stage this evening, we're very keen to get your views. They're very keen at Emirates NBD that this should be an interactive discussion, and in a few minutes' time, I'm going to show you how to use a device on your smartphone called Slido that's going to help you participate in this evening's event, because they're very keen to get your questions and also your views on some of these burning issues. And with that, I'd like to hand over, if I may, to our first speaker this evening, indeed, our perhaps host this evening. It is, please give a very warm welcome to the Senior Executive Vice President, Head of Retail Banking and Wealth Management at Emirates NBD, Subasaka.
Dear honored guests, welcome to today's event inspired by your success. A very good evening to you, and I hope that today's session will inspire you to ask yourself, what's next? With your patronage, Emirates NBD continues to set benchmarks in the UAE banking landscape. In 2018, we delivered a record set of results and hit two big milestones. Milestone 1 was hitting a net profit of 10 billion dirhams for the first time, a 20% rise over the previous year. And milestone 2 was build an asset book of 500 billion dirhams, again, for the first time for the bank. But that's not all. Through 2018, as in the previous 5 years, we continue to digitize, enabling paperless sign-up for new products and to transact online. I'm proud to say we get the awards for the best online and best mobile platforms in the country. Our new digital bank, Live, today is the fastest growing bank in the country. In fact, signing up more accounts every month than the mother bank, Emirates NBD, does. Our investments in service helped us deliver better user experiences. Our brand, Emirates NBD, which is just 10 years old, continued to strengthen in terms of value, and our social media following continued to grow. We continue to win awards, in fact, pretty much every single award in the country and the region. But more importantly, our customer satisfaction scores from customers like yourselves, continue to increase. In parallel, and this is something that we are really proud about, is we took the opportunity to give back to society through staff volunteering and through a focus on sustainability. We encourage people to give in to giving, to give in to giving, with a video that we launched on World Kindness Day last year that touched 80 million hearts. That's the single most popular video out of this region. Thank you. Thank you for your support. Thank you for your patronage. And thank you for your advocacy of Emirates NBD. We live in a rapidly changing world. The future is not what it used to be, and the markets have become increasingly volatile, making the transition to a more perilous, not just year, to a more perilous decade for our customers. To help us navigate in these turbulent times, we put together a session for you that is being hosted by our Chief Investment Officer, Maurice Gravier, and his entire team of investment experts. Thank you for taking the time out from busy schedules. I know how busy you are, and I hope you find the evening both informative and enjoyable. And once again, thank you for your custom.
Super, thanks very much indeed. Suro was kind enough a couple of weeks ago to give me a tour of the offices of Live, the new digital bank, and I can promise you that is a bank that is built differently from the ground up. But that's a discussion for another day. Let's get on with the investment outlook. Now, I mentioned earlier on that the guys at Emirates NBD genuinely want it to be as interactive as possible. And one of the ways we're going to do that is with something called Slido. So if you can pick up your smartphone devices, please, and I'm sure most of them have got those with you. Can we bring up the slide that explains how Slido works? Slido is simply a website that you go to, and it operates like a very, very simple app. So go to www.slido.com. They've got free Wi-Fi here at the Four Seasons. You've got Wi-Fi login passwords on your table there. So go to slido.com. Can we pull up the slide? Yeah, we've got the slide here. And what it will do, it will ask you to put in a code. That's the code. Hashtag CIO19. Hashtag CIO19. And once you push that in and press send, it will take you to the homepage of this evening's event. The hashtag's already there, CIO for Chief Investment Officer, and then 1919. And then you'll be there. It doesn't do an awful lot, Slido, but it does two things really, really, really well. Firstly, it allows you to ask questions to some of the experts up here tonight. Simply write a question, press send. We won't get to all of the questions, but we'll get to as many as possible. And the second thing that it allows you to do is to vote. We've got some questions up here, some multiple choice questions, only 3 of them, not loads. It's not an exam, we're not at school, but there are some questions we'd love to get your view on. How are we doing with the app? Have we all got that? Yep, I see some nodding heads. So what we're going to do now is pull up the first question. that we're going to ask you. Can we get the first question up? Here we go. And it's about asset allocation, because the first three presentations we're going to hear tonight, they're short presentations. We're going to get the asset allocation, if you like, the macro view. Then we're going to do a deep dive on two assets in particular, fixed income and equities, and we've got questions on all of those. So let's begin with asset allocation. In particular, you can see the question, what is, in your view, the key investment risk for the future? This is a bigger picture macro question. So you can vote now. Don't forget to press send after you've made your choice. You have to press send. If you see in the top, my left-hand corner, your right-hand corner, we can see a number there. That tells us how many people have voted. I reckon there's a couple of hundred people here. So now we're up to 101. Excellent. I'll give you a few more minutes, or not a few more minutes, a few more moments just to fill that in. But looking at some of the options, looks like political uncertainty is running away with it at the moment. Debt is an issue. I know Maurice is going to talk about that a little bit later on. But the others down at the bottom, climate change and complacent valuations, they don't really seem to be moving the needle at the moment. It's the politics that seems to be keeping you guys awake at night at the moment. I'll give you just a couple more minutes on that. We've got I have 128. Do I see 130? Oh, we do see 130. There we go. I'm not going to be an auctioneer this evening. Going once. Going twice, your last chance to vote, going 3 times, done. So it looks like political uncertainty is the winner. So with that, I'm going to hand over to our first, if you like, analyst speaker this evening, someone who's going to give us some insights on the markets. To talk about asset allocation, will you please join me in welcoming the Chief Investment Officer of Emirates MBD, Maurice Gravier. Maurice, join us, please.
Is it? Yes, fine. Hello, good evening, everyone. We are delighted to have you here, and the entire investment team from Dubai, Singapore, and London is really extremely happy to share with you our views on our global investment outlook 2019. And before you get tired by my French accent, I will start with our key message to make sure that you have it. We're not only entering a new year, we have to get prepared to a new decade for investors, which will be probably very different from the previous one. And this is the previous one. Had you invested in December 2008, this is what you would have get 10 years later. You would have made money everywhere. Not that much on cash and hedge funds, but with equities, you would have doubled your capital and almost tripled it with real estate and high-yield bonds. These very good numbers of the last decade include the negative returns of last year that you can see here in orange across all markets and all regions. You could see last year as simply giving back some of the extraordinary gains of 2017 in white. But it was not just that. There was more. There was the return of volatility, fueled by concerns which were not small questions. Is it the end of the cycle? Is it the end of quantitative easing? Is it the end of globalization as we know it, of politics as we know them? There are big questions. Volatility is back, and these questions have not found an answer. This is why we think that last year was a transition to a new decade. So investment for us is a journey. Our job is to transport your capital over time between now and the time horizon of your goals. If it's a journey, the last decade was a wide and flat highway under the sun with no speed limitation. Now, it's the end of the highway. So let's look at what we have in store for the next decade as regards the economy, valuations, and risk. First, the economy. It looks familiar. What you can see, these gray bars, that's the recession periods in the US. And what we can see, and I will take the risk of falling maybe, is that we haven't had one for long, for 10 years. It's unusual. It will not last forever. If you look at history, if it's a guide, and it is, just before recession, you have the US yield curve, which goes negative. We're not there yet. And you have the unemployment rate that begins to go up from low levels. We're not there yet, but it will happen. The laws of gravity apply, so we will have a recession in the US, and in the rest of the world probably, because it's not just the US, the world is decelerating, and having a downturn in the economy, it's not unusual. What is more unusual is that this is the total amount of global debt in the world, an astonishing 250 trillion US dollar. And what is more striking maybe is the fact that there has been a sharp increase in the last decade. Households have been reasonable, banks have been reasonable, corporates and governments have borrowed a lot because of quantitative easing, low rates. What does it mean? Of course, more risk. You could have default, you could have these kind of things. It also means that growth will be constrained, because when the economic downturn will hit, not if, when, governments and corporates will be more vulnerable. They will not be able to face it with the easy solution of the last decade, borrowing more. So it means the next downturn could be longer or maybe deeper. So we'll have less growth. Second point is valuation. This chart in orange, it's the long-term valuation of US equities. It's a multiple on 10-year earnings, and it is since 1881. But let's first look at the bars. These blue bars are the average annual performance that you would get with US equities adjusted for inflation. And I must say, there is a very good news in this chart, is that since the 19th century, all this period, with all the history that happened in the meantime, it is quite exceptional to lose money if you hold equities for 10 years, even adjusted for inflation. It doesn't happen very often. That was the good news. The other news of this chart is that there is a link between the valuation and the returns. When you buy cheap, you have fantastic returns ahead there as well. We are not cheap at all. And actually, we have only been more expensive once on this metric during the TMT bubble. So it doesn't bode well for future returns because there is a link. And actually, it's more than a link. It's absolute statistical correlation, and there are very reliable models to predict 10-year return. There is no model for the short term. And these models don't give you a clue on timing. They don't give you a clue on the trajectory to reach the number, but the number is reliable. We have thought that 2018 was the ideal time to calculate returns for all asset classes. We've dedicated lots of time to that, and I'm very happy to share the results with you. And I'm next to the table, so that's good news. These are the returns you can expect, annual return for the next 10 years for the major asset classes, based on very objective, very robust models which work over 10 years. And as you can see, if you compare to the previous decade, it's not exactly the same story. There are good news. Cash is back as an asset class. You still can find some good returns, especially in emerging market assets, but overall, it's not as good as what it used to be. The future is not what it used to be. So we all have to be aware that expected returns looking forward are not super high. What about risk? This is the magnitude of the variation that we've seen this year. Yes, the last one, it's Bitcoin. I know it troubles a bit, but you've seen markets going from plus 10% to minus 15 in a year. This is volatility. Is it here to stay? Yes, it is here to stay. We'll have some risk because of fundamental reasons, lots of debt, low visibility on growth, because of political risk. You've highlighted it as your first concern, and I must say that I agree with you, especially in Western democracies. People vote for different leaders, they have different politics, and also for technical reasons. 90% of the market is in the hands of algorithmic trading, and it has happened precisely in the last decade. So these models, they fight each other in the same millisecond. How would they react with more volatility? They're not used to it. So, sorry for the message, but it's not an opinion. It's a fact. We will have lower expected return with some risk. It's the end of the highway, and we have a desert to cross. So, should we just stop here and don't cross the desert? Of course, we don't think so, because wealth management, it's all about the magic of compounding returns over the long term through the good and the bad times. That's how it works. If you are out of the market, it means that you have to time the market, and this is very difficult. We can also say that if we have a desert to cross, here we know that it can be safe and even very enjoyable. It's about preparation and skills. And this is a good news because we think there are 3 keys to successfully navigate the next decade. The first one is to have the right portfolio construction. It's discipline. The second one is having the ability to adapt to changing conditions. When you're in the desert, sometimes you accelerate, sometimes it's better not to do so. And the third is the benefits of selectivity. Let me take you through them. First, what is the right portfolio construction? You have to take more or less 3 things. First, golden rule, diversification. Always, not all the eggs in the same basket. It's a kind of French expression I'm trying to translate, but I'm sure you got it. Diversification across assets, also across geographies, more than ever, because globalization is receding. The things that happen in emerging markets are different from the US. The time of everything going up at the same time is over. So diversification, of course. Second, it's taking into account the new realities of expected returns and risk. You've seen emerging markets are more interesting. We've put more. Cash is back as an asset class. Fantastic. Let's put more. And the third, and I must say the most important, is to define the strategic asset allocation in our jargon. In the way we speak to you, it's more about profile, to define them around what is really the core mission of wealth management, not losing money. We have reshuffled our 3 profiles around this idea. We built cautious, moderate, and aggressive with an absolutely dominant probability of not losing money out of 3, 5, and 7 years. That's how we define being cautious, moderate, and aggressive. I think it's clearer than a volatility. Then, expected returns are the result of that. It's not the other way. We'll not ask you, how much do you want to make in the next 10 years, and then we'll put you somewhere. No, we'll ask you what is your horizon, and we'll deliver on that promise. Expected returns are not fantastic. Again, we owe you this truth. It's the world we live in. It's not an opinion. It's more or less 4%, 5%, 6% per year. Not very exciting. However, I told you there are 3 keys to navigate your environment, and the 2 others are there to make better. Second key is the ability to adapt. We talk about volatility. For a long-term investor, volatility can be your friend, because what it means is that markets will undershoot and overshoot their fundamental fair value. So if you have an idea of the fundamental fair value of an asset, it gives you the opportunity to adjust, to add, to reduce. That's exactly what we've done in our report that you'll find on our tables. And my colleagues will tell you more about that. We have calculated fair values for all asset classes. We've done that in November, based on a macro scenario from our excellent team of economists. And there you can see the growth forecast that they have for 2019 in blue. Yes, it's decelerating, but it's not the end of the world now. We've taken that into consideration. We've calculated fair values in November. We didn't have many conclusions, and then December came. Everything went down. And suddenly we found out that, yes, there is no upside anymore in government bonds because they are too expensive. But there is upside in equities, and that's what gives us our positioning. So this is how we start the year. We have reduced government bonds. There is no upside potential. After this risk-off, it was fully done. You're better off with cash, honestly, because it gives you yield and flexibility. We have added to global equities in January. For return, we like equities and emerging market assets in general. For the defense, we like cash and gold. We also have a fair value on gold of 1,400. This is our positioning. This is how we start the year. Maybe in a typical year ahead, I would have spent 25 minutes on that. But the key message is not that much how we start the year, and so far so good, it works fine. It's that we will change depending on opportunities that will appear and disappear based on this valuation. And my colleagues will present their valuation in a minute. Finally, I told you there are 3 keys to navigate the decade. The third one is selectivity. Let me put it bluntly. The markets have been dominated by passive investing. And Richard was referring to books, including Warren Buffett, saying that you should just buy an ETF on the index. We believe it will change. It is controversial because it hasn't worked. The last 10 years, all you had to do was to buy an index, the cheapest possible replication. But why? You had fantastic macro factor behind it. You had quantitative easing, steady growth, visibility in politics, which are the very things that are changing. And we think that in a world with less growth, there will be a difference between the best business models and the others. In a world with too much debt, there will be a difference between the one who can repay and the others. And we have asset class experts, and I'll leave the floor to them in a minute, that will tell you your preferences. Maybe a last word on ETFs and indices. Emerging market, I'm sorry, I think I should breathe sometimes with them. Emerging economies, 40% of the economy, 12% of the global equity index. Simple. Is there an anomaly? We think so. Emerging economies are growing twice as fast, and it's going to be probably the same in the next decade. Fixed income, you say, oh, I will buy an ETF on global government bonds. This is safe. Yes, it is safe. You have 28% of the index in Japan. You lend money to the most indebted nation in the world for a negative yield. Japan is paying a negative yield. This is why some ETFs are fine, some others you should have a look, and we think that selectivity is the third key. So I think I've been a bit too long, but if I can sum it up, yes, the next decade will be challenging, there is no doubt. We are aware, we are all aware, we have realistic assumptions, we are prepared for it, and we are confident because we have your trust, and because, please remember my first slide, December 2008, it was the middle of the global financial crisis. The best investment opportunities come in turbulent times. So with that, I thank you for your attention. Oh, my God. I was wondering.
Thank you very
Sorry.
much. He wasn't sleeping here, really. I'm not accusing him of that. Thanks very much indeed, Maurice. Fascinating insight. I hesitate to say I enjoyed them because the message was quite a stark one, but I certainly feel a lot more enlightened about what to do with my money over the next 10 years than I did 20 minutes ago. But as he said, we're now going to drill down into some of those specific areas, starting with fixed income. Can we bring up the fixed income question, please? Once again, if you can pick up your smartphone devices, please, and go to Slido. This is the question for you. What is currently your preferred fixed income investment? Have a think about that. And again, once you've made your selection, don't forget to press send. If you just make the selection, then Slido's not going to know that you've made your mind up. Make your selection, and then boom, press send. Let's have a look at this. Cash is making a comeback, as Maurice said, and it seems like quite a lot of you agree with that. Just what? 10% for developed market government bonds. Again, echoing what Maurice mentioned there. Emerging market government bonds getting a little bit more love than their developed market counterparts, but certainly cash deposits for a fixed income investment. 52, more than half of you looking at cash deposits. That is a fascinating insight. How have we had? We had 120 so far. Let's see if we can get to 130 again. It's kind of the magic number. 3, 2, 1. 131. Thank you very much indeed. Right, we'll wrap up that poll for now and move on to our subject matter expert. Please join me in welcoming our next speaker this evening, the head of fixed income strategy at Emirates MBD, Yahya Sultan. Yahya, thank you.
Thank you. All right, I know I'm not supposed to vote, but I think I just voted for EM government bonds. All right, this time last year, we preached to all our investors that the fixed income asset class would be challenged. We witnessed some deep gyrations across the asset class, leaving us with lasting memories. This sell-off on bonds has actually got in some meaningful and plenty of opportunities for 2019 and beyond. Let me start by saying that last year we've seen three major setbacks for the asset class. First, of course, was country issues that was seen in Turkey and Argentina. Second, of course, the Federal Reserve policy response of 4 rate hikes. Last but not the least, the most important driver for jolting the asset classes were cash. Cash, the return of the asset class. Now, let's start with central bank policy actions first. This is the first and foremost fundamental on our case study. ECB. They finished buying bonds from the market, which is also called quantitative easing. Now they're planning to lift rates. Now, we all know lifting rates is not easy. You need growth, you need inflation. Still, those numbers are quite poor in the Eurozone. Rates are still negative, right? So let's forget about it. I probably say this at the next event in 2020. The Fed, all eyes are going to be on the Federal Reserve. 2 hikes, 1 hike, or none remains a question mark. We as Emirates NBD, official house view is for 2 rate hikes, which should push the rate to 3%. Now, we understand the fact that market future pricing for the next 12 months is indicating probably a rate cut. But again, to repeat, we need 2 rate hikes. The next candidate, the most important for us, is PBOC. I know many of you all might not think so, but they are quite a powerful institution. They literally own and control the financial system in China. And when they respond in terms of policy actions, the whole world starts to get worried. Now, the big picture. Let's start with the big picture, what we're trying to say. A very simple chart is on policy normalization in the US ahead of the end of a long decade economic cycle. So policy normalization, I'm sure most of you all have heard, it's where rates stabilize. We've been saying for quite some time that 2.5, 2.75 is where the Fed policy rate should stop before that next cycle comes. Because you know Fed needs to react at the next recession cycle, and at this point of time, they probably could, but if you have 2 hikes further, it'll be in a comfortable situation. Long-term yields trend is lower. Inflation, after years of stimulus in the US, has been quite stubborn. So the trend is going lower. We call it the beginning of an end of a higher rate regime. Now, this is music for most of the bond investors. I call it the playbook. For the first time, I would say in the last 4 years, I'm now beginning to put cash on my playbook. What does that mean? Is this shows you how valuations stack up on the fixed income asset class. It's a very simple chart. It's not rocket science. So EM sovereign bonds stack up right on top, and global high yield, the axis on the bottom shows the duration for your investments. All right, so these are the fair value estimates for 2019, where we feel should be. Treasuries, US 10-year, currently it's at 2.66. At 2.85 levels, we'll start accumulating it. We have a very strong conviction. They act as a dual play, right? So they act as a hedge on your portfolios, and they give a good source of income for your bond portfolios. Global investment grade. Corporate bonds still has a lot of value. Balance sheets are sound. Many have gone through corporate restructuring. The capitalization programs have gone well. And we think that it's still a fairly decent asset class. High yield, more vulnerable in this late economic cycle. We still feel that there could be a little bit weakness that could come out if interest rates and liquidity really dries up, and also if there is a spike in default rates. Emerging markets, this is core. This is a very important asset class. It has a long investing portfolio positioning as well as a good storyline. We cannot ignore 2/3 of global growth comes from emerging markets. And it's a significant contributor to global economy. If I had to break it down, I would still like on emerging markets is domestic bonds, given the outlook on the US dollar. And second, I would like emerging Asia. That's our preferred play within emerging markets. Now, GCC also belongs to the emerging markets, but I have clubbed it separately for the sole reason. We at Emirates NBD think or feel that GCC bonds are absolute different kind of asset class to the traditional bonds. They offer value. They have a good, strong technical bid, which means home bias. The regional investors always prefer this asset class. And third, home to the Islamic capital markets. So let's sum it up. We like corporate bonds over government bonds, investment grade over high yield. That's in a nutshell. Of course, global investment grade will keep adding to our positions, EM, long-standing conviction, and of course, developed market, as Maurice alluded before. 2/3 of it is still negative yields, and I don't want to place my money there. We reduce take profits on developed market government bonds, and on high yield, of course, we are reducing our allocation. Thank you.
Thanks very much indeed, Yahya. It's interesting, Yahya mentioned the People's Bank of China there and how important that is. And a little bit later on in the panel discussion, Li Yang is going to be one of the panelists. He heads up investments for Emirates NBD in Singapore, and he's going to be giving us his thoughts on what's happening in China now and what will happen going forward. So I'm looking forward to that one very much. But now we take our final deep dive of the evening into equities. And before we welcome our speaker, let's bring up the third and final of our questions this evening, which is about the equity markets. Here we go. It's about the S&P 500 in particular. After what we saw in 2018, what will be the total return for the S&P 500 in 2019? I'm sure you know how Slido works by now. What do we think? Is it just too unpredictable? Well, lots of you think it is. But some of you are prepared to have a punt. Not many people expecting bumper returns more than 10%. Very, very few. But that range of plus or minus 10% seems to be what we're settling on. I'm going to give you just a couple more moments now to have a think about that. And don't forget, press send afterwards. I keep forgetting to press send, but press send, and then it will register. Wonderful. Thank you very much indeed. So the winner seems to be plus or minus 10%. With an honourable second place for It's Unpredictable. And with that, I'm going to welcome our equity specialist now. Please join me in welcoming to the stage the Head of Equity Strategy for Emirates NBD, Anita Gupta.
Thank you. Good evening, everybody. I'm here to talk about equity strategy for 2019 and the next decade. So my challenge here today is that you stay connected to me and not to your smartphone. Technology is everywhere. We resent it for its invasion into our privacy and for the unauthorized use of our data, but we also welcome it for the connectivity it gives us to our family, our friends, our car, and our healthcare. So let's stay connected. 2018 began well and ended badly. The US had a stellar run till September and then had the worst December in 50 years. Emerging markets began a sell-off in February, which continued till the year end. Chinese technology sector fell 30%. 2019 year to date is an inverted image of the performance of 2018. China and emerging markets are the best performers year to date. The US market has had its best performance in more than 30 years. What has changed? We have the same headwinds. We have increasing leverage. We also have trade tariff disputes that are continuing. Globalization, now that's a term coined by a Dutch trend watcher. It means slower transport of goods across borders. But is localization bad? No. Let's look at Inditex, the owner of Zara. Now, they manufacture locally. They have sales of over $30 billion, and they believe in getting the product to the customer within 6 weeks of design. That definitely helps them. When we look at the next decade, we think growth will be driven from emerging markets, quality, selectivity, and data analytics. Growth in emerging markets has taken over from US exceptionalism. Emerging market growth, our in-house estimates are for GDP growth at 4.2% in 2019, and that is double that of developed markets at 2%. Earnings growth too is double that of developed markets. Asia today is the consumption engine of the world. 34% of India's population is millennials, 31% of China's. These millennials are today the working group in the world, and this is in contrast to the developed economies of the US, Europe, and Japan, which have an aging population and a big drain on healthcare and pensions. 1990s was the decade of the desktop. 2000 was the decade of the internet. 2010, we began an era of mobility, and currently we are in the data era. Big data will define the next decade and its myriad applications in the industry, whether it be gaming, browsing, video streaming, or healthcare diagnostics. 90% of the global data has been generated in the last 2 years. Artificial intelligence uses this data to predict both human behavior and how humans will buy. 4 very simple ingredients to sustainable long-term returns. First, companies that innovate and invest grow. Amazon spends billions of dollars every year on R&D. Its latest investment into Aurora is to improve its automated logistics. Google has 300 subsidiaries seeding new ideas. The second ingredient, buy growth but at reasonable valuations. Last year's correction gives us this opportunity in emerging markets and the financial and energy sectors. Thirdly, look at ESG strategies. These are getting more popular as today investors look at both the companies that have lower carbon emissions as well as food that is sourced sustainably. Fourthly, look at quality. By quality, we mean companies that have lower leverage and have cash flows to service the debt. This should help you build a portfolio which will outperform in the longer term. We look at the major markets across the world, and we have built some models to estimate the fair values for the major indices at the end of 2019 using a simple valuation multiple and the earnings growth that we estimate. For the US, for the S&P 500, if we take a forward earnings multiple of 16.5 times, if we look at a very reasonable earnings growth of 5%, the index should be trading at 28.25 at the end of the year. That should give you returns of about 16%. When we look at emerging markets, similarly for the MSCI Emerging Market Index, if you take just a simple earnings growth of 7%, which is quite low, you should get returns again of about 17 to 18%. Now, we have already progressed quite a bit towards our fair values for a lot of the markets, already met in Europe and the GCC. Our fair values are actually way below what consensus expects, hence we are fairly optimistic that these will be met. So the question that was asked at the beginning of the panel and where we expect US returns to be. Now we know that after last year everybody is fairly nervous, but these are, again, as Maurice pointed out, these are facts. A low earnings multiple, a low earnings growth, and yet we see upside for the US in 2019. To focus on what we like in 2019, I'm just going to cover very quickly the GCC, emerging markets, and technology. Now, in the GCC, we have seen that companies that pay out dividends consistently and have sustainable cash flows to service these dividends are the ones that outperform. The KSA has led market returns in 2018 and 2019. KSA banking sector has up 50% starting January 2018. The UAE banking sector has given returns of over 30% from January 2018. Of course, the banking sector has been helped by higher interest rates. In the KSA, we have also seen returns because of inclusion in the emerging market indices, but that's not all. We think that continued reforms and improving economic growth is going to continue returns for the KSA. In the UAE, what we like are the banking and logistics sector, the latter as e-commerce is growing in this region. Also, when we look at oil and we look at an average of Brent at $65, which is our in-house estimate, increased government revenues means a flow through to the private sector. Emerging markets. Now, in the emerging markets, we are seeing increased allocation as slowing growth in the developed market means that investors look more to these growth areas. Emerging markets today are the powerhouse of connectivity. China and India lead on fintech adoption, and this also means increased online sales and increased spend. China today has Alipay with more than 500 million registered users. India's Paytm adds millions of users every month post-demonetization. In India, people are using WhatsApp, that's the latest digital channel, to transfer funds. Also, very important for emerging markets, they trade at half the valuation of developed markets. In technology, we would like to be selective. We don't have the exponential growth that we have seen from the traditional technology sectors. What we would focus on in the year and the coming decade is data and security and the services around them, whether it be 5G, whether it be autonomous transportation, connected healthcare, or anything to do in these areas. However, remember to buy growth at reasonable valuations. Thank you.
Anita, you could have kept it thicker because you're the last person to be giving a presentation this evening, but thank you very much indeed for returning it. Right, dinner is 25 minutes or so away, perhaps even less than that, but before that, we have our panel discussion. I'm going to invite our experts on stage. But now, I'd encourage you to take Slido. The polling bit is done. Now it's a case of asking questions. So if you do have a question for any of our panelists, and Maurice is going to be up here a little bit later on as well to take your questions, you can start firing them now, and the guys from Emirates MBD are going to moderate those questions, and we'll get to as many of them as possible. And with that, let me now welcome our panelists this evening, Tariq bin Hendi, Khatija Haq, we have Omid Salak Haddadi, and also Ti Hyang. Join us please on stage. Thank you very much indeed. Now, one thing I would ask our panelists to do, pick up your microphones, choose your weapons, and start your engines. Please turn the microphones on. We'd had them switched off beforehand. And what we're going to do, kind of geographically, we're going to start local in this region, and then we're going to go west for a little while, and then we're going to go east for a little while, and then we'll get to questions. Tariq, if I can turn to you. Tariq is the Executive Vice President, Head of Products and Advisory, Retail Banking and Wealth Management with Emirates NBD. A very local question. What's next for Dubai after Expo 2020, Tariq?
Thank you, Richard. I think it's an important question because we've been focusing a lot over the last 5 years on the build-up to the Expo, and not a lot of people have been talking about what happens after the Expo. The one thing that I can say is that, if anything, Dubai is innovative and it's constantly reinventing itself. So I am sure that there is a plan being worked on in terms of the next big event that Dubai will host. But I think one thing is very important to focus on, and that is the fact that historically Dubai has always pitched itself as the center of the world. You can get to everywhere from Dubai with one flight. I think what the Expo allows Dubai to do, and the UAE from a broader perspective, is not only showcase what it can do to the world, but have the world come and showcase what it can offer through Dubai. And I think that's a key differentiator to how things have been done over the last 25 or 30 years in terms of how Dubai operates. And that is going to set the stage for all these international firms really looking at Dubai now as a hub, I think if you look at all of the different initiatives from a government and legislative perspective in terms of changing residency rules, company ownership, agency laws, I think the future beyond 2020 is very bright for the UAE, and I think that the Expo is really kind of setting the stage for that.
Final question on real estate. You're also chairman of Emirates MBD REIT. I mentioned that one of the three things keeping our listeners awake at night is the Dubai real estate market. How are you reading it at the moment?
So I take a slightly more pragmatic view to the real estate market because I use the context of 2009, 2010. The same conversations that we were having then are what we're having today with some of our investors. And what we found in 2009 and 10 is that the investors that were willing to come back into the market in that time frame did very well for themselves. The other thing that you have to keep in mind is that the real estate market is cyclical globally. This is not a Dubai phenomenon. This is something that's happening everywhere. You're starting to see the signs of the real estate market in cities like New York, San Francisco, London, all starting to take a beating. In fact, there's a very good indicator that you can use that a lot of real estate agents use in the US as a benchmark, and that is how long an asset stays on the market in New York. And I know it's a very odd one to bring up, but I'll bring it back to Dubai. 2 years ago, the average apartment in New York, over $3 million, was on the market for less than 18 days before it was sold. Today, it's over 180 days. So the real estate markets, I think, globally are starting to struggle. One thing that Dubai has demonstrated is that it is resilient. And I'm not here to give, a positive speech on Dubai and everything that it's accomplished, but I do think that investors need to look at 2009, 2010 as a reference point, and from a relative perspective, look at how things are so much different today in terms of the regulation, the debt that's in the market around real estate, the end users that are buying this. So I think it's a very different situation. I do think it's stabilizing in terms of certain asset classes, but you have to be selective. And to what Maurice was saying earlier, you have to cross the desert to get to the assets that you're looking for. And I think that there are some fantastic opportunities in the market if you're willing to make a bet on the fact that it will rebound.
Tariq, thanks very much indeed. Khatija Haki, if I can turn to you again, looking at the regional situation. This is not our first conversation today, is it, on regional economics? On the business breakfast this morning, we spoke with Khatija because one of their economic reports came out today, the Dubai Economy Tracker for January, and it was pretty good, wasn't it? So give us the overview of the macro picture for the UAE and the wider region.
So yes, the January survey data that we've seen over the last week or so has been quite encouraging. It showed a pickup since December. But when we look at 2019, I would say our view is cautiously optimistic. We do expect growth in the GCC to be faster this year than it was last year, but we expect that growth to really come from government spending and government investment. All of the governments across the region have basically announced bigger budgets than they have in 2018, and that is probably going to help to drive growth. We also are expecting oil production to contribute to faster growth this year. But the question around GCC growth has to be on sustainability. And if governments are driving growth, then that becomes vulnerable to oil price shocks, which is where most of the government revenues come from. So that's a bigger issue that needs to be addressed.
If I can ask you a question about oil prices. In fact, Christine Lagarde mentioned them this week. The head of the IMF was in Dubai. And she was talking about oil prices still being important to this region. So, A, where do you see them headed in 2019? And B, how do you see progress towards diversification away from oil? And if I can ask you to hold the microphone nice and close so we can hear your answers fully, please.
So our view for oil prices is an average of $65 a barrel for Brent this year. So that's slightly lower than the $71 average that we saw in 2018. Now, I do have to stress that volatility, as Maurice mentioned earlier, is very much here to stay. So that doesn't mean that we don't see oil prices below 50 or we don't see them above 80, but we think that an average of 65 is a reasonable expectation, and certainly most of the budgets that have been announced for this year assume something around $60 to $70 for oil. So we think that's a reasonable expectation. In terms of diversification, it's something that's talked about a lot, particularly from the IMF and the World Bank. And we have to ask, why is diversification important? What's the point? Well, there's two big reasons why it's important. One is demographics. The region has a young population that have to find employment over the next 10 years, and the oil sector doesn't create jobs. So if you want to create jobs, you have to do it through non-oil sector growth. The second reason it's important is because if diversification is driven by governments, or if growth is driven by government spending, then it becomes very vulnerable to oil price shocks. The minute oil prices fall, government spending contracts, and you end up with a recession. And so you could argue that, yes, governments in this region have used oil revenues to try and create diversification by investing in the non-oil sectors, but actually that's not really the way they should be addressing the issue. The way that they really should be looking at it is, how do we attract private sector investment to drive non-oil growth? Because that removes the element of risk around oil prices. And so if governments in the region were to focus more on creating the right environment for both local private sector investment and foreign investment, then to my mind, that's a much more sustainable approach to drive medium-term growth than simply spending more when prices are high and spending less when prices are low.
Khadija, thanks very much indeed. So that's the local perspective. Let's head west now. Omid Salik Haddadi is Investments Director for Emirates MBD in London. Omid, one word for you: Brexit.
Right, I'll do
and in particular, but how do we play Brexit as investors, impact on financial markets?
Okay, yeah. I mean, I'll do my best to summarise. So the UK clearly left, or gave intention to leave, or voted to leave in June 2016. We set the date for our departure, 29th of March, 11 a.m. in 6 weeks' time. Despite several attempts, a deal really has not been reached. And the one contentious point amongst the whole Brexit negotiation really is Ireland, and how to avoid a border in Ireland, which is clearly not tolerable by any of the Irish people. Now, the entire Irish situation has put the UK in a terrible negotiation phase with Europe. A deal hasn't been reached, and with the deadline looming, it's only 6 weeks away, it really has cast a huge shadow on the state of the UK and its longevity. I mean, the Bank of England recently came out, revised down its growth forecast, it has revised down its rate hike expectations, and it has revised up its probability of recession to 25% in 2019. It's clearly not a good place to be in. Two things, however, are certain. Whatever the arrangement with Brexit, it will increase the cost of trade. No matter how many ways you chop up the Brexit agreement, the price of trade will go up naturally through tariffs or through increasing transport costs or non-tariff related items such as regulation or standard setting. The other area to really be concerned about, which is our concern most of all, is foreign direct investment in the UK is a huge contributor to productivity. It brings technology from offshore into the UK. It removes the reliance on your home market for technological advancement. Foreign direct investment in Europe is 42% of all foreign direct investment in the UK. So clearly, if a deal is not reached and a relationship with Europe isn't there in 6 weeks' time, foreign direct investment will suffer. That much is certain about the economy. Now, I mean, how does this translate, and how has asset prices reacted? I'd say the one most obvious recipient of the concern and uncertainty around Brexit is the value of sterling. You saw it fall from a long-term average of 160 to 150, down sharply to 120, and we're now trading at 130. The currency aspect of things, the markets are rewarding a potential extension to the Brexit deadline. The markets are rewarding a soft Brexit outcome. And as soon as rhetoric changes towards a no deal or a hard Brexit, the markets are penalising sterling significantly. However, ironically, this is the situation we're in the UK, is that the soft, part of it is due to the fundamentals, really, of the FTSE 100 and the UK property market. I'm going to focus on those two because I think they're the most certainly relevant. The FTSE 100 is a hugely international market. It generates 70% of its revenues, FTSE 100 companies, from outside of the UK. So as a result, the translation effect of a weak sterling has really boosted the FTSE and boosted all blue chip companies in the UK. Now, will that last? Unlikely. Could those other more structural problems to do with Europe and the UK relationships that I mentioned before impact the UK equity markets? Absolutely. So there is cause for concern, and that's why you've seen the FTSE or the blue chip companies still remain so elevated. It's really down to that currency effect. The second area to talk about, I suppose, is real estate. London in particular was the largest market globally for commercial real estate transactions last year. So despite the concerns around Brexit, the buyers are still in the market, principally, again, ironically, because of that soft sterling position. If you look at London or the UK as a whole, it still does have those structural, significant factors that contribute to investors coming in and buying UK real estate. Rule of law, property ownership rights, ease of transactions, those things, Brexit or no Brexit, should remain. However, that said, we have seen softening in commercial real estate, particularly those sectors within commercial that are more exposed to the economy, and less so in those sectors of commercial that remain largely defensive around the infrastructure side or around the PP&I partnerships that you see within the real estate broad sector.
Ahmed, thanks very much indeed. Let's go east now for our final bit of commentary. Thi Hiang is Head of Investments for Emirates NBD in Singapore. And Thi Hiang, I'm going to put to you the question that I know you get asked all the time, and it's this. Are manufacturers in China moving their production to other countries in the region to circumvent US tariffs? And is there a risk of a so-called hollowing out of China's manufacturing base because of this trend?
I think the argument that it's thought about a lot is that do you move your manufacturing base into another country? And for the purposes of discussion, let's use Vietnam, right? And you move there because, first of all, there's cheaper labor, and now you save on the tariffs, which could come up to 20%. But I think that is a very simplistic way of looking at it. I think there are still reasons why companies will still stay in China. Firstly, let's look at your raw materials. The raw materials that you need to use to produce your goods and services. Take your products, for example. Can you be assured of the quantity and the quality that you're getting now, guaranteed as what you get in China today? You might not get it in Vietnam. Next, you look at the technical expertise in Vietnam, right? Your technical people, your engineers, your accountants. Will you get it in Vietnam? Maybe, maybe not. Likely so. So there are reasons where we call technical capabilities that's available in China that has been built up over the years, this complex and integrated, what you call supply chain dynamics ecosystem. Point number two, China is a big market, way, way bigger than Vietnam, right? If you are going to sell to China, why move out of China? Ultimately then to export back to China to sell it. Why do you move out from your home market, right? So you rather stay there. Third point, finance. Not so much in terms of getting financing to loans and things like that, because multinationals generally don't have that problem. But can you convince your board of directors, your shareholders, to finance a new operations in another country? Will they want to take the risk? Will they want to go out of their comfort zone, right? So there are a multitude of reasons why companies will still stay in China. I think it is possible that there will be companies that will move out of China because of the tariffs, and generally these companies are companies which are into low production margin based companies, right? But by and large, I think the supply chain ecosystem that has been built up in China is what we call integrated, is very cost efficient, and I think it is not easily replicatable somewhere else.
Thanks very much indeed for those insights. Right now, let's get to your questions very quickly, and for that, I'm going to welcome a fifth member of the panel. Please welcome back to the stage Chief Investment Officer at Emirates MBD, Maurice Gravier. Maurice, join us, please. Thank you very much indeed. And as Maurice joins us here, thanks very much indeed. You can still send your questions now. I'm going to ask my colleagues if we can have the first question, please, up on the screen. And then I'm going to fire these questions, first of all, at you, Maurice, and then if there's one of our subject matter experts who wants to have a pop at it, then they can do. Can we see them on a little comfort monitor down here? If possible, that would be great. If not,
I can see it.
You can see it.
What is the best products mix for a cautious investor? Thank you very much, Mr. Srivastava. The good news is that there is a wonderful document on your table, and it's on page 2. No, sorry for the advertising minute. We define a cautious investor, again, in our new framework by saying you shouldn't be losing money in 3 years. So, frankly, let me be very direct. If your horizon is shorter than that, if you need your money in 1 year, stay in cash and make a fixed deposit with Emirates NBD at wonderful rates, given the security of the bank, as Shuvro has described it. If you have 3 years, the mix we have is more or less 20% cash, 50% bonds with some inclination to emerging markets, 20% equity, and the rest between gold and hedge funds. And I see product mix, and maybe if you allow me, because the magic of the bank, I think, is the asset allocation, but also having access to amazing products. And this gentleman, Mr. Benendi, has teams who have an amazing open architecture platform, which will give us the best external expertise where we don't have ourselves. And so typically, for emerging market equities, we have wonderful external managers, because typically in emerging markets, the beta is interesting. We like the markets themselves for their perspective and their valuation, but it's a fantastic pool for alpha, because these markets are less efficient than typically the US with the algorithm in microseconds. And this is why the magic is certainly the asset allocation with the best expertise.
We'll move on to the next question now, before we involve all of our panelists. Can we have the next question, please? Here we go. Maurice, you forecast several waves of change coming in 2019. What are they, and do they suggest an end to the great bull market of the past decade? From Anonymous. I don't know if that's the hacker group Anonymous, or someone who chooses not to give their name.
So another question for me, and I've just done something weird with my mic, so I will keep quiet, so I move a lot. Wave of changes. No, it's a fascinating question, and we have, it's not one wave of changes.
I'll tell you what, do you want to take that microphone off, Maurice? And I think I've got a handheld microphone I can give you here. Is it there? It's not quite there. If you can borrow a microphone.
Thank you very much. And sorry if I break the hardware, I'm sorry.
No, first of all, he wants to steal the clicker. Now he's broken the microphone. You're going to get a very big bill at the end of the evening, Maurice.
Sorry for that. So the waves of change, really we think that it's more a mindset of uncertainty everywhere. Typically the big topic of the moment is probably not the Fed anymore. It used to be 1 month ago, but now it's quite clear. Now it's this US-China question, and Young will I'm sure agree with me, and it's a fascinating topic. It's the art of the deal in front of the art of war, you know, one US president having to be re-elected next year in front of China, thinking probably 20, 30, 50 years, and Mr. Xi, who doesn't have to be re-elected. And this is, I think if there is a big wave of change, it's probably for the years to come, the opposition between these two superpowers. That's the big one. As regards the end of the great bull market of the past decade, I would say maybe, as Tariq was saying for Dubai real estate, there is one reinsuring factor. You know, we look at macro valuation and sentiment. Macro, we've seen it, valuation, it's expensive for the long term. Sentiment, we cannot say that there is some euphoria now, and this is very positive. And it's the same for Dubai real estate. Crises don't happen when everyone is calling for crisis. That's something, I've done 20 years in the industry, and I've been wrong. Each time I was euphoristic, and everyone is worried. So I don't think this is the end of the bull market now. It's very difficult to time anyway, so it's about having the appropriate portfolio construction and trying to adjust around, not being out of the market, because you can miss, typically this year, global equities are up 7-8% in 1 month. You know? If you miss that, you miss part of the long-term expected return that you have.
I'm going to ask that question to each of our panelists from a regional perspective, just a 30-second answer, and then I'm going to finish with Khatija from an economist's perspective. But first of all, if we can get the Asian perspective, T. Hyang, what do you expect for the next decade?
I think the opportunity set in Asia, I think with regards to the tariff wars, it's well known in terms of the negativities. But what I would like to share is what's happening in terms of the positiveness that we see. So the Trump administration now has seemed to be a bit more reconciliatory to what's happening in China. Chinese leadership also is a bit more positive. There seems to be a deal that will be struck, or at least a partial deal that will be struck, right? Nonetheless, our view is that these trade wars will continue in the medium term as long as the trade surplus between the US and China continues to remain high, right? Nonetheless, I think we do see some positiveness coming out of what has happened in the trade war. Firstly, the Chinese government and the policymakers have stopped what they call the deleveraging in the economy, which has really affected confidence. Second of all, they are putting into a lot of structural reforms. They're starting the fiscal reforms, structural reforms in terms of tax cuts and things like that. And finally, I think, all these things, if you look, there will be short-term pain. However, in the long term, the structural reforms that they put through, if they get it right, will be positive for China, will be good for the region in general.
Tariq, your outlook for the next decade for the domestic market here?
So if there's one thing that's certain is that we live in a region that's constantly clouded by uncertainty, at least as it relates to the geopolitical risk. But that's been the case for the last 50 years. And so if you've been worried about geopolitical risk over the last 50 years, you've missed multiple waves of economic expansion and opportunity. So as far as I'm concerned, the way that I look at this is that people need places to live, people need places to educate their children, they need places to eat, they need healthcare. There are sectors that will remain resilient. If you look for that resiliency, and if you look for opportunities where other people are running for the hills, or running into the desert, I should say, instead of out of it, you probably will miss the opportunity. So I do think that there will be some geopolitical noise, but again, we're in a region that's constantly filled with noise. If you drown that out and you actually look for the sectors and the segments and the right partners, there's a lot of opportunity.
And then finally, from a European perspective, Omid, and you're based in the United Kingdom,
right.
the next decade, who knows what the next 6 weeks hold? Right. I'm going to ask you to look at the next decade.
Sure. I think I'll again reference sort of two major asset classes. I mean, the first will obviously be real estate. I think what is here to stay is the hunger that investors have for yield. And that's across the board. That's not only in the retail and wealth space, but it's also across the institutional space. Pension funds are hunting yield assets down aggressively, whether they be commercial assets, infrastructure assets, or high dividend yielding equities. So I think that searching for yield really will pick up and should maintain throughout the year. Secondly, I think another very important point, which Anita, my colleague on the equity side, was touching upon, is that technology is increasing at a rapid pace. It's not your traditional technology sectors. These are technological advances that are penetrating into every single sector within the economy, whether it be from warehousing and smart warehousing technologies to AI or the more traditional software technology sectors. I think that particular trend, I think we've only really just seen the start of it, from banking sectors all the way down to real estate.
And finally, Khatija, what's the one, or just tell us one big economic story, macro story, it could be regional, global, whatever you choose, that we need to think about over the next decade?
I'm going to focus on the region because I think there's too much globally to talk about. But if I had to say what would be the big game changer for the region over the next 10 years, it would be creating an environment that allows greater investment from the non-government sector. And it's going back to that diversification story. But what that means is looking at regulations, looking at the openness of economies. And I think this is something which the region has already started to do, particularly if you look at Saudi Arabia and the way that they have opened up various sectors to investment. We haven't yet seen the benefit of that, but I think that's going to come. But it's things like, the ease of doing business, the costs of doing business. I think that's a really big theme that we're hearing from both large corporates and the SMEs, is that, this region is actually an expensive place to do business. You start looking at regulatory frameworks, policy continuity, policy predictability. If investors are coming in to build plants, if they're coming in to put real money on the ground and they are investing in the real sense of the word, they need to be comfortable with the environment that they're investing in. They need to have confidence in the regulatory framework, the legal framework, the leadership. And that's something which I think has to be built over a period of time. And I think that is being recognized. When you look at all the development plans that have been launched across the region, all of them rely on foreign investment, foreign technology coming in. And so the right environment has to be created to achieve that.
Right, we're almost out of time, aren't we, Maurice? Can we take 2 or 3 more questions? But what I'm going to do is make them rapid fire questions. So you're going to have 45 seconds to answer each one. Okay? Go. Question from Anita. Anita, do you want to join us on stage? Happy to let you take this question. Again, just 45-second answer. You mentioned buy growth at reasonable valuations. Do you believe 16.5 price-earnings ratio for the US is reasonable at such low GDP?
Yes, I do think that at the moment we are at reasonable valuations for the US. If you look at the 5-year average forward price to earnings, it is at 17.8. So definitely the US on a forward price to earnings is cheap. You still got growth. You still got buybacks happening along with dividend at over $1 trillion. So definitely, yes, the US is also home to the largest technology and healthcare companies. These are global companies and they're providing the necessary growth to keep the market up.
Very quickly though, Maurice, do you agree with that? Because you showed a different PE ratio. You showed, is it Robert Schiller's cyclically adjusted price-earnings ratio? And you were suggesting that it's almost the highest it's been in history. Do you agree with Anita? I'm sure you do, your colleagues, but explain that, because it seems almost incongruous.
It is a... Oh my God, how many seconds do I have for this very fundamental question?
3.5.
Because all we have to do is to try to reconcile long-term valuations, which are absolutely expensive, really they are, with amounts of debt that are crazy, with objectively, I totally agree with Anita, because the PE of the US, yes, 16.5 times PE is expensive. Now, it's below average. It's expensive in absolute. It might sound expensive. It's below average. And if you take into account the level of rates, the risk premium, when you can get 5% out of a US 10-year treasury bond, you don't have to bother going into equities. You have 2.5, 2.62 or something like that under the control of Yaya. Let's say you have 2.5% return on a 10-year US bond. It means a PE of 40. For the bond. And in that context, it's not that crazy to pay 16.5% for US equities. And we do fair values based on that.
Thank you very much indeed. Very quickly, next question. Thanks, Nilesh, for that great question. Indian price earnings is extremely high. Anita, come back. This was in your slide as well. I'm thinking of putting some money in India at the moment. I'm an overseas citizen of India now. I can do that. But it does look a little bit expensive.
Okay, so India is trading at a trailing price to earnings of 20 times. It is actually probably the most expensive major market today. And Indian growth, the earnings growth is expected at around 20%. Now, there is a lot of fear around the upcoming elections, and we have seen foreign investors pull out money, but India has a strong domestic economy. Now, what will drive Indian earnings growth? And Indian corporate earnings growth is probably the highest in the world amongst all emerging markets. India's also got the highest GDP growth. So we don't think that India is an expensive market, and anybody who's looking at a 3-year horizon from here is looking at the consumption story of the world.
Thank you very much indeed. Next question, we'll take 2 or 3 more. Thank you very much. Is it a good time to buy property in the UK this year?
Right, I'll try and be concise. So with property, of course, you have 2 sectors, residential and commercial. So they have very different return drivers. Residential property in the UK is suffering and has suffered from the additional tax burdens that have come in over the last few years. In addition to that, prime central London is suffering from an oversupply issue at the moment. So would it soften further? I'm not going to speculate, but it is on the downtrend. Commercial real estate, on the other hand, has very, very different return drivers. So, as I mentioned before, the large commercial assets, those store of value assets, are being driven by sterling weakness right now. Are yields widening? Is prices generally falling? I think it didn't happen throughout the course of 2018, but towards the end of 2018 and into this year, we are seeing yields widen. We are seeing clients that can negotiate yields in the up to 4% levels on commercial real estate in London.
That's your 45 seconds. Yes or no?
Depending on your risk profile, and if you're a global investor enjoying the benefits of weak sterling, then yes.
Thank you very much indeed. Can we take a couple more, Maurice?
Oh, of course.
Yeah. Let's have 1 or 2 more questions. Again, rapid fire. GCC bonds or fixed deposits? We need another special guest appearance, don't we, from this?
Yeah, please.
Yahya's back on stage.
All right, I'm happy to take this question. Yes, definitely it's going to be GCC bonds. I mentioned the cycle is turning, rate cycle is done. If you asked me the same question last year, yes, deposits, but now the cycle is turning. You don't want to miss out the opportunities in a great bull run.
GCC bonds, thank you very much indeed. Let's pick up the next question if we have one. Do we have more questions? No, we've been told that that's it. Time's out. Dinner is served. Thank you very much indeed to all of our panelists this evening for their contributions. To Chi Hyang, thanks very much indeed for joining us from Singapore. And to Omid from joining us from London, Khadija Haq and Tariq here in Dubai. Thank you very much indeed. And of course, to Maurice, making his debut at this event as Chief Investment Officer of Emirates MBD. It's been an absolute pleasure and a privilege. Thank you very much indeed, Maurice Gravier, for your insights as well. And of course, most importantly to you, thank you for giving your time. As Suva Sarkar mentioned earlier, we know you're busy. The fact that you've given your time to be here, we really appreciate it. For taking part in the questions and the polls, we appreciate it. And now let's enjoy a well-deserved dinner. Thank you very much indeed, and good evening. Hey.